Good afternoon. This is Tom Alexander. It is Saturday, January 11th. It is about 2:15 p.m. Eastern Time in beautiful Charleston, South Carolina. It's a little chilly here. Um, okay, interesting situation as usual setting up in the U.S. stock indices. This is the weekly report that I do every week. If you're new to the channel, if you find value, please like and subscribe. I send an email out when I do these things. If you're not getting those emails, send me an email to tomalexandertrading.com, or let me show you something else you can do. You can go to my website, alexandertrading.com, and click right here, sign up for a weekly newsletter. Also, you can click here and the you can get the report for this weekend and then the previous weekends going back several years, including a PDF and including all the videos if you want to see what I have been saying up to this point and see if you think that I consistently know what I'm talking about or not. Okay, let's take a look at the indices. Now, let me make sure I'm showing what I want to be showing. Yes, I am. Okay. Um, all right, we're just going to go through each one. There's really a lot to discuss this week. Uh, you can see now there's a lot of information on this chart. First of all, what are these lines here? Well, these are the levels that I think are important. I'm always reluctant to use the term support and resistance, but typically levels below are quote unquote support, levels above are quote unquote resistance. What they really are, though, are inflection points. They are points to monitor. I use only auction market information, which is basically means that I only use information that is provided by the buyers and the sellers. I don't use magic numbers, fibs, all this other stuff, all this magic pivots, the floor pivots, any of the magic stuff I don't use. Uh, I think if you will go back and look, and again, you can go to the weekend reports and you can look at the levels that I've been posting for 2 years and see what you think. But let me explain what these levels are and how they were derived. To the upside, we have Thursday session high. Why is that level important? Well, it's important for a couple of reasons. The previous day range extremes and the day before that are always important levels, first of all, every day, every new day. Secondly, Friday was a big report day. We had a gap down and lower trade. Indices closed on their lows. So that makes Thursday's high important because of the fact that the big money, at least on Friday, deemed that to be an unfair value and they're driving it lower. You can also see now we're closing below this level that has been tested several times. We closed below this level. Now, the next level to the downside is going to be the close/high of the fifth, which would coincidentally close a gap. Now, I'm not one of these people that obsesses over gaps having to be closed. Most gaps are closed, and that's just because of the rotational uh, function of an auction market. But a lot of people pay attention to that. So if a lot of people pay attention to it, it becomes a self-fulfilling thing. So yeah, this is a level to keep an eye on. However, I think it's far more likely if we're going to go lower, you're going to see this level in here, this 5705, 5670-ish level in here. That would set up a really interesting situation, I think, from a technical perspective that I'll get into in just a minute. Also, I'll point out we have now gone 22 trade days off of the session high. That is the longest period of time by a long ways since the ramp that began in October of 2023. We have had this dip and rip in process for well over a year now, and this has been a grind lower so far. There's been no big release to the downside. We'll see what comes of it. All right, let's take a look at the other indices. And something else, if you'll notice, I talked over and over and over last year about how disparate the structure was among and between the primary U.S. trading indices. Well, everything's in sync now. So that's telling you something. When things get in sync, it's telling you something. And it gives more credence to the direction that most of the indices are heading, which at this particular moment happens to be down. So here's the level in the here are the levels in the NDX. Now, you can, again, you can go to the website and you can download a PDF that has these levels in there if you're interested in a hard copy, or you can just go check it out on the website. They're posted on the website. You don't have to, obviously, you don't have to refer back to this video. So there's the NDX, the Dow. The Dow was really cratered, and it's just above a level here. Below this level, it's in an elevator shaft that goes all the way down to the September low. And then the Russell, this is a weekly chart of the Russell. The Russell is more difficult to find a good level because this entire move from here was a very two-sided chop fest grind. We just ticked to a new all-time high here, could not close at a new all-time high, and now the Russell is in retreat mode here. The Russell is sort of its own animal. I don't have much more to add to the Russell. Now let's look at the New York Composite. It had quite the move down off of this top, a bounce, and now we're approaching this spike low that occurred on 1218, 1220, that time frame. All right, let's take a look at the internals here. And we'll come back to VIX. I want to start with breadth. Now, bull markets and bear markets have differences. To me, bear markets are easier to trade because you have more volatility. It's easier in bear markets to identify both potential lows and tops. In bull markets, it's extremely difficult to identify tops because divergences just don't matter. Markets continue to grind higher and higher and higher. The tops tend to occur in sort of a air pocket fashion where just for no reason the market will drop 3% in 4 days, V bottom, and you're at new all-time highs. Bear markets are a little bit different. All technicals in particular, I'm going to talk about the ones I use because I don't use oscillators, indicators, all of that other stuff. I use market generated information, specifically NYSE data, advancing declining issues, and then breadth, which is the net of advancing and declining issues each day. On my chart here, you see three quote unquote indicators. Below, the red is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of NYSE advancing issues. The blue is a histogram of breadth, closing breadth. Now, back on the 18th, we made really a multi-year low in the 10-day moving average of NYSE advancing issues. And before this occurred, and you can go back and you can look on the weekly charts that I have posted. I posted that we could be putting in a very, very important low, and we did almost to the day. And we had a subsequent base ripping rally as you would expect. What didn't occur and what is different this time, and this is important, that rally failed. We had another attempt at a rally that has failed, and now we're making a lower low below the low made when we registered this extreme in the 10-day moving average of NYSE advancing issues. Now, if we are in a bear market, you will get lows when the 10-day moving average gets down into this level right here. Okay, and I'll go back and I'm going to show you this. Now, we've been in a bull trend. And if you notice, every time in this bull trend, we've reached down to this level, we put in an important low. We did here, we did here. We have secondary lows in here and that created face ripping rallies. Now, something else I'll point out, the green arrows up here indicate negative 2000 closing breadth. In bull trends, those are relatively rare, and they almost always occur coincident or very, very close to important short-term lows. So we had a little bit of a bear trend beginning in the summer of 2023. Then the market bottomed in October of that year, and we've been ripping higher since. I think this was the first leg of the bull market. Then we had sort of a correction. This was all bear market in here. And what do you see that's different? You can see all these negative 2000 breadth readings. Are we going to have another series like this? Well, this is something else to watch. But also, even though we were in a bear market here that began in well, January 2022, 3 years ago, you can see when the 10-day moving average of NYSE advancing issues reached down into this extreme, you got ripping rallies. And I expect that to occur again. That's why I say I think it's easier to trade bear markets than it is bull markets, because you get great counter trend moves in a bear market. In other words, rallies. In bull markets, you don't. You might go 4 months and have a 3% retracement, and you miss that because it occurs in 2 days out of the middle of nowhere. Bear markets are to me, generally speaking, and again, this is generally more predictable in what they're doing. They follow technicals more clearly. They honor levels better. So we'll see if indeed what happens. Now, if we do get a big dump next week, if we get another wide range down a couple of days into this area, and we get the 10-day moving average continues to roll over and reaches at least the upper cusp of this downside extreme, the 5-day gets extreme, maybe we're putting in a low. It would be perfect if it occurred into this level. We'll see. We'll see, but that's something to keep an eye on. Now, what if we're in a bull market? Well, if we're in a bull market, you've got a big divergence here in this 10-day and the 5-day, and you're going to turn around not far from Friday's low. Even if it makes a lower low, we're going to go ripping higher again. So how do I know if I'm wrong? Well, I'm wrong if early next week, if Monday or Tuesday, the market reverses. We have wide range up days in all of the indices, and we have a breadth reading of plus 18, 19, 2000. I did a special report at the end of last week. I said the same thing then. I'm repeating that now. That's how I know I'll be wrong. It's fine to have an opinion. It's fine to have an assumption about the direction the market is going, but you always have to know what invalidates that idea. You do not want to marry your opinion, my opinion. You don't want to marry Twitter's opinion. Okay, let's take a look at VIX. Now, VIX did not quite reach 20. In a bull trend, 20 is high. In a bear trend, it's not. So be careful if you are among those of us, and I do this. I trade the volatility products, the ETFs in particular, the futures sometimes. You cannot lean on the fact that 20 is high if we're in a bear market. If we're in a bear market, the VIX can stay above 20 for weeks. Okay, the 20 level can become a floor as opposed to a ceiling. So be very careful making the assumption that VIX is high here. High is a relative term. Okay, guys, I hope you found value in this. If something dramatic happens before next weekend, I'll update again. I'll speak with you guys again soon.